In terms of scheduled news, the coming week's due to be relatively quiet. But with a war on in Eastern Europe, commodity prices staying volatile and the cost of living surging, markets are unlikely to be quiet, especially as events could take a hand at any time. The main macroeconomic item of the week is likely to be the latest monetary policy decision from the Reserve Bank of Australia. Governor Philip Lowe will make the announcement on Tuesday the 5th of April. Big deal, I can hear you cry. But the RBA's decision will be interesting to see if it joins the wider global trend to tighter monetary policy. According to the website www.cbrates.com, central banks around the world have raised interest rates on 71 separate occasions already this year. In the whole of 2021, we just saw 113 rate increases, so we're well on the way to that already. In addition, there's been just one cut this year, and that came from China back in January. As a result, the direction of travel seems pretty clear. Central banks are raising rates and tightening policy as their concerns switch from unemployment on one hand to inflation on the other. Even the Bank of England's raised interest rates 3 times and the US Federal Reserve once. However, Governor Lowe and his colleagues down under have yet to move. At their last meeting in March, the RBA left the headline cash rate unchanged at 0.1% for the 15th time in a row. However, the central bank did stop adding to its quantitative easing or QE program, having acquired around 300 billion Aussie dollars worth of government and municipal bonds since the global pandemic began. Australia's headline inflation rate was 3.5% at the last record in December 2021, somewhere below the multi-decade highs we're seeing in the UK, US, and Europe right now. That may give Governor Lowe and the RBA some wiggle room, and he does say he's waiting for more signs of wage inflation before acting, although waiting for historic data has led to accusations in the US and UK that the Fed and Bank of England left it too late to start moving. We'll see, but the RBA's latest policy pronouncement should be an interesting litmus test. Corporate news flow is expected to dry up a little in the coming week, although again there could be some scheduled announcements that prove worthy of further research. Names which may be worth a look include the following, although there's always a chance that some of these dates could be subject to change at the last minute. Beaver Group on Monday the 4th of April, HomeServe, Moonpig and Gooch and Housego on the 5th, Tops Tiles, Great Portland Estates and Hilton Food on the 6th, Robert Walters on the 7th, and Charat Gold on the 8th. But the stock which could perhaps create the biggest fuss in the week ahead is Entain Group, the only FTSE 100 firm slated to make an announcement in the coming week. Once known as GVC, the owner of the Ladbrokes and Corals high street bookmaking chains and provider of online gaming and gambling services around the globe, well, it's set to release its first quarter trading update on Thursday, the 7th of April. Entain shares are up by around 10% over the past year and have gained more than 200% from 2 years ago. That advance owes something to lockdowns and the pandemic as bored householders look for something to do. Entain's strong position in the US sports betting market, which continues to open up after the 2018's repeal of 1992's Professional and Amateur Sports Protection Act, is another factor, and there have also been failed takeover bids for the company in 2021 from both MGM and DraftKings. MGM's all-stock offer equated to £13.83 per Entain share, whereas DraftKings offer £28 a share in cash. However, both bids foundered, lockdowns have ended, and some shareholders may now be fretting about the outcome of the UK government's review of the 2005 Gambling Act, especially as Britain represents just over 1/3 of total group revenue. Much tighter regulation and checking of affordability, customer losses and maximum stakes could, according to some, make it harder for punters to strike a harmless wager in their usual way. Supporters of the review say it will protect the most vulnerable in society and the families of problem gamblers as well, although Entain will counter by saying that it introduced its own range of checks back in spring 2021. The first quarter updates from the company do tend to be pretty brief, and the headline figures will cover the like-for-like changes in net gaming revenue for both online, via sports and gaming, and also what Entain calls retail, which is the high street betting shops. In 2021, Retail generated about a fifth of revenues, by the way. Entain has set out two targets for 2022 in terms of net gaming revenue, or NGR. Mid to high single-digit percentage growth from online, with 2 percentage points of that coming from acquisitions, and a continuation of the trend seen in the second half of 2021 at retail, where NGI was running at more than 90% of pre-pandemic levels. Overall, analysts are looking for 15% revenue growth across the group in 2022 on a stated basis, though again that does feature acquisitions. Also watch out for any comments on the US 50/50 venture, BetMGM, where the partners have a goal of NGR growth of more than 50% to above $1.3 billion this year, buoyed up particularly by the opening up of New York. Also watch for comments on individual markets. Into 2021, Australia, Brazil, Italy, all very strong. Germany and the Netherlands less so, owing to, yes, wait for it, tighter regulation. And again, any comment on the UK's regulatory review will be worthy of note. Analysts and shareholders will also look for any comments on profit guidance for the year. Entain's preferred metric is earnings before interest, taxes, depreciation and amortization, or EBITDA. In 2021, the firm earned £882 million in EBITDA, and analysts have penciled in a figure of $1 billion for 2022. Underpinning that is management's target of a 27 to 28% EBITDA margin from the online operations. Finally, the balance sheet will gather attention. Entain ended last year with £2.1 billion in net debt. Management's cash allocation priorities remain in order: investment in organic growth, acquisitive growth, debt reduction, and then returns to shareholders, which helps to explain why the firm didn't pay a dividend in either pandemic hit 2020 or 2021. I hope that you and your families are all in good health and good spirits. Thank you for watching, and I look forward to seeing you again next week.